In today's video, we're looking at two different investment strategies. Should you buy the dip or should you dollar cost average? The results may surprise you, and the results aren't even close. Coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, and we're trying to bring you good, solid retirement information to help you make better decisions so that you can retire well. I found an article by Nick. I'm going to show him here because I can't even begin to pronounce his last name. It's entitled, "Even God Couldn't Beat Dollar Cost Averaging." Well, that's a bold title and a bold claim, so what he did was do some research on whether buying the dip performed better over a 40-year period or whether dollar cost averaging did better. So imagine that you've dropped somewhere in history between 1928 and 1979, and you have to invest in the U.S. stock market for the next 40 years. You have two strategies that you can pick from. The first one is to dollar cost average, where you invest $100 per month for all 40 years. The second strategy is where you buy the dip. You saved $100 a month and you only buy the market when it's a dip. So an important definition, or what are they considering a dip? That's defined as any time in the market that's not at an all-time high. But I'm going to make the second strategy even better. Not only will you buy the dip, but we're going to make it so that you as the investor are omniscient, so that when you buy, you will know exactly when the market is at an absolute bottom between two different all-time highs. So imagine the stock market goes up and makes an all-time high. It goes down, and then it goes back up to make a new all-time high. Whatever the lowest point is between those two highs, you would buy right there. This would ensure that when you buy, you're getting the lowest possible price for that dip. The only other rule of the game is that you cannot move in and out of different stock prices. Once you buy, you're going to be holding for the entire time period. So given these options, which one do you think would do better? I mean, you would think that having the omniscient power of buying the lowest dip between the two different peaks, it would have to be the better strategy. This is what subconsciously we all want to do, and we think that it would be better. But what does the data show? What it actually shows is that the strategy of buying the dip underperforms dollar cost average 70% of the time. This is true despite the fact that you knew exactly when the market was at the bottom between the two all-time highs. And so what makes this true? Buying the dip only works when you know that it's a severe decline and you can time it perfectly. Most severe dips don't happen too often, so therefore the strategy rarely beats dollar cost averaging. And if we took away your omniscience of perfect timing, where your buying was right exactly at the dip, and we moved you by 2 months, where you either bought 2 months before the dip or 2 months after the dip, meaning that the dollar cost averaging goes from winning 70% of the time to winning 97% of the time. So let's look at some of the data. Here's a chart from January 1995 to December 2018. All of these green dots are the all-time highs. So buying the dips would be any of the lowest point between the two green dots. So here you can see there are red dots for each omniscient buying of the dip. Now the one that really stands out is the March 2009 dip, but all the other dips aren't standing out as being that significant. Here's a chart that shows how the buying of the dip works. You can see around 2000 or so, at the last red dot, you would have bought the dip. Then as it goes down to March 2009, you can see how you've saved a bunch of money on the green money to make that purchase. Then in 2009, as it goes up, you can see down the bottom with the green cash. You're saving up money until the next purchase at probably around 2013. One reason that dollar cost averaging wins is that the earlier the payments are invested, on average they grow more thanks to compounding. There are only a handful of big dips like March of 2009. Those obviously work out quite well, but the other dips are missing out on some of the compounding interest. Buying the dips work incredibly well when buying the dip happens early on. But if you look at longer time frame, historically, buying the dip does not outperform most of the time. So here's a chart that shows positive numbers of buying the dip outperforming, and if it's below the 0% line, that's when buying the dip underperforms. You can see here in the 1920s to 1930s, and a little bit in the late 1930s, that buying the dip strategy was beneficial and it outperformed. From about 1940 through current, you can see dollar cost averaging is winning. The big takeaway of the article is that if you attempt to build up cash to buy the market at the next bottom, you'll likely be worse off than if you just bought every month. So why would it be? Because while you wait for the next dip, the market is likely to keep rising and leave you behind. And remember, if you miss the bottom just by 2 months, it causes the dollar cost averaging to go from a 70% winning to 97% of the time it wins. And we all know we don't have omniscience to always pick the bottom. So for most of you in your TSP, this is going to be welcome news because you are purchasing on a systematic every pay period basis with every paycheck. But as you enter retirement, you won't be contributing any longer. Having the right allocation that matches your tolerance level matters. Check out this video right here. Why is your TSP invested like it is? What strategy are you using? If you want more information about that, watch this video right here. If you need help, go to ChristyCapital.com, click Talk to an Advisor. My name's Mel Stubbs. I'd love to talk to you.